Greetings, it is time for our monthly monetary creation report where we look at how much money printing has been done worldwide on a cumulative basis and also examine whether money printing is in fact causing inflation and how much inflation is there despite the large amount of money printing. So as always, we go to the Yardeni report, which is updated frequently, and the link for which is in the description box below. They've changed the order of certain graphs in the Yardeni report, and the ones that used to be at the top are now at the bottom. So figure 14 is what used to be figure 1. That is fine. We will focus on the ones that are relevant over here. And this is the cumulative money printing of the 4 major central banks of the world that comprise about 85 to 90% of all world money printing. You have the U.S. Federal Reserve, the European Central Bank, Bank of Japan, and People's Bank of China. And as you can see, the U.S. Central Bank, the Federal Reserve, is just one of the 4 and has done a little over 25% of the world's total money printing. It is not the majority money printer. A lot of people who are desperate to see inflation as higher than it actually is tend to pretend that the United States is the only country in the world, and they say that the Federal Reserve has printed so much money, therefore things that are priced worldwide, such as gold, would go up. And that is wrong on 2 different levels, but the first level is that the U.S. Federal Reserve is not even the majority of all money printing. It is currently the highest of the 4, but substantially below its peak, and its peak was well below the European Central Bank's peak. So the U.S. Federal Reserve has done only 7.4 trillion out of this grand total, which is 26.2 trillion. And since money printing is worldwide and borderless, only the grand total matters. Some countries can print a lot of money, but it flows into another country. Therefore, segregating how much one central bank did versus another, much less pretending as though the U.S. central bank is the only one printing a lot of money, is factually wrong and illogical. So the grand total of these 4 is what matters, so we will go to that. The blue line is the sum of all 4 of those central banks. The red line is the sum of 3 of those central banks, excluding China. The reason there are 2 lines is that the Chinese data is updated on a delay, and therefore this line does not go as far to the right, time-wise, as this line. But we nonetheless care about the blue line because it is the grand total current as of March 24th. And that means $26.2 trillion has been printed. And this is a logarithmic scale on the vertical axis, as we can see here. And so this is exponential. It took a lot of time to go from very low printing up to $20 trillion of money printing, but then the next 10 trillion took almost no time at all. And even though it is being slightly unwound from the COVID peak, it is still well above what it was pre-COVID over here. And so this general trend line is still towards exponentially rising money printing. I contend that technological deflation, the ambient deflation that is created by a greater and greater percentage of the entire economy becoming high-tech, is something that has to be offset by money printing that grows at a rate of 16 to 24% a year. And through my proprietary calculations, I come to that band. So what is important here is the annual compound growth rate of this blue line, and we see that above. Again, these charts are in the reverse of what they used to be in the old version of the Yardeni report. That's why I'm going upwards to see this chart. We saw figure 14, then figure 13, now figure 12. And the red line in this case is the growth rate of the 4 major central banks in the world. This is a little bit confusing because over here the red line excludes China, but over here the red line includes China. So that is confusing. I might send a note to them to at least be consistent on color codes. But over here, as you can see, even when they printed money, it only very briefly got to high growth rates. In February of 2021, due to the COVID stimulus, the red line got up to 43.1% as a matter of fact, and that is a level at which even I would say that is excessive money printing that can cause inflation, and we had 1 year of inflation, as we will see in part 2 of this video. But since then, they've been unwinding and have been in negative for quite some time, when in fact the healthy cruise control speed is 16 to 24%. So over here, like it was in general for this entire decade plus time period, it's sort of like a highway. There's a certain minimum speed and a certain maximum speed, and if that is followed, then the highway flows smoothly. You should not exceed the maximum speed for a sustained amount of time, but you also should not go below the minimum, and you certainly should not go in reverse. Now, this would normally cause a market correction, the stock market, that has not happened yet for reasons that are a bit mysterious. So let's look at the final chart over here. This is the sum of the three central banks, the trajectory. It does not include China, of course, but this is both left and right axes normalized to each other, so the addition of China would not change the gradient of this axis, even though the absolute number changes. And the S&P 500 usually correlated with this for the entirety of the decade plus before this divergence. But now we have this divergence that is unexplained because this is the first time that the market has continued to go up while money printing has been going down. And there are a couple of theories about this that I've explained elsewhere on this channel. And I used to do crash watch videos because this seemed to be a very predictable market crash, which may yet happen, but I don't know when it will happen and why this has been decoupled for so long. But just to match this line, you would have to come back down to here, let's say. The theories for why this has not occurred is that AI has created so much market optimism and buzz that there is a certain bubble forming, much like the dot-com bubble in early 2000. And that is keeping the market elevated for a certain amount of time. The second possibility is that there's a new type of money printing that is going on, which could in fact be true because the M2 money supply has not been falling despite money printing going down. But I do not know for sure, and I have not found anyone else who does either. I have in fact done videos about how there might be a new type of money printing being done that is off balance sheet, but at the moment I cannot say that with any certainty. Now we'll go to my decade scorecard. This is my decade scorecard to reveal my prediction as opposed to the predictions of the economics establishment, all those PhDs from the top institutions. And as you can see over here, in the 2010s decade, $23 trillion of money printing was done, and the PhD economists reading their textbooks about how money printing causes inflation because they are tied to economic assumptions from the mid-20th century were entirely confident that this new decade, the 2020s, beginning from January 1st, 2020, would see a reversal of the original money printing, $23 trillion. Whereas I said, no, money printing is exponential because technology is rising exponentially, not only in power, but as a percentage of the total economy, and that this decade would do $50 to $100 trillion of new printing. Forget about printing reversals. $50 trillion if it is in the form of cash sent directly to people, which is what it has to migrate to because that is a lot fairer and more diffuse versus what is being done now, which is simply the purchase of mortgages and treasuries by the U.S. Federal Reserve, as well as the central banks of the other countries that we saw. They're doing a similar amount of narrow money printing rather than cash. So in that case, it does not diffuse quite as well, and that would require 100 trillion if bond buying is still the way they continue to do QE, which at the moment it is. This could also break the system because it's causing hyper distortion in just the asset classes that are being purchased, while too little is percolating to the broader economy, and it is in fact drawing vital life energy from the rest of the economy. So I would urge them to go to cash sooner rather than later. And they probably won't because they never innovate except under duress. And that is why we have those economic crises and fiscal crises that we tend to have. But 50 trillion if cash, 100 trillion if bond buying in this decade of the 2020s. And now we are almost at the halfway point of this decade. We are 4 years and 4 months through this 10-year period. And how much has been done? $8.7 trillion. So it's certainly not going in reverse. And which of the two predictions appears to be the one that things are trending towards? Their negative $23 trillion prediction or my plus $50 to $100 trillion prediction? And remember, this is exponential, which means the vast majority will be done in the second half of the decade, not just the first half. 8.7 trillion has taken 4+ years does not mean that the remaining 5.5 years will only have 12 trillion or so. This is exponential. That is why money printing, quantitative easing of the scale we saw in the 2010s after the 2008 market crash was not something that was actually happening before 2008, let alone in the 1990s or earlier. So this scorecard indicates that my prediction is the one that things are trending toward, which should not be a surprise at all once one understands the connection between technology, deflation, and money supply. Now we move on to part 2 of this video, where we see whether all this money printing has in fact finally caused an aberrantly high amount of inflation. So we continue to part 2. And as always, we return to my familiar matrix, where I take a multi-dimensional approach to inflation as one should. So my position has consistently been that all three of these measurements have to be above 3% before I say that inflation is structurally high. And even then, that does not mean that inflation is because of quantitative easing, at least directly. But until all three of these measurements are above 3%, inflation is not structurally high. That is the 10-year compound annual growth rate of the US CPI, the 10-year compound annual growth rate of the Goldman Sachs Commodity Index. This is the most important measurement of the three, and the 10-year US Treasury yield. We take these 10-year windows in order to smooth out short-term blips because the news media is able to take a high inflation reading in 1 month and scare people who are desperate to see themselves as victims, and then the same news media does not emphasize months that have lower than trend inflation. But we look at all of those. And all three of these at 3% is what would actually be optimal, because that is when technological progress is the highest relative to the least amount of suffering for individual people, especially the poorest people. Remember that inflation is fuel for technological progress, as I describe in my atom thesis. Very few people understand that. And this does not mean that it's a catastrophe even if any of these measurements are above 3%. 3.1, for example, means slightly above optimal, and so forth. So we first go to the 10-year U.S. Treasury yield. The 10-year U.S. Treasury yield, 4.5%. So this is substantially above 3% and has been for some time. If I take the 2-year chart, you can see when it crossed 3%. This is more a measurement of expected future inflation versus past inflation. However, this has a tremendously huge impact on housing prices as well as lending in the broader economy, 4.5%. Now we go to the Goldman Sachs Commodity Index. This is the Goldman Sachs Commodity Index, 10-year compound annual growth rate, minus 0.86%. It is in deflation, and oil is cheaper than it was 10 years ago. It is in fact still far below the record high it reached in 2008, 16 years ago. And here's why this is the most valuable and comprehensive measurement of inflation of all. One, it is worldwide, so it is not dependent on the inflation of any one country. The US CPI is a US measurement, and inflation in the US is higher than in Japan, China, and the European Union, whereas this is worldwide. Secondly, commodities are freely traded, so it's impossible for this measurement to be rigged. Many people like to say that the CPI is rigged to understate inflation. That is not true. But nonetheless, the Goldman Sachs Commodity Index is even more obviously not rigged because it comprises of freely traded commodities. That is why people should use it as the ultimate measurement of whether the negative type of inflation exists and is harming people. And what do I mean by the negative type of inflation? Commodities are where indisputably inflation would be bad and deflation is actually good if in commodities. That is not true for services because wages are tied to service prices to a much greater extent. When services inflation is higher, that is simultaneous with someone's wages also being higher. The service provider got to charge more. So when someone says, well, the service I paid for became more expensive, but the service that I'm providing I can charge more for, but I'll only complain about when I have to pay more, not when I'm making more, that is absurd, and that is why it's much more ambiguous about service price inflation being a negative. That's why commodities are the purest component of what would be unambiguously good or bad. And a lot of average people who like to scream about inflation, they are not smart enough to understand these nuances because they simply assume that inflation is bad, deflation is good, because inflation means they're paying more, deflation means they're paying less. It does not occur to them that their boss will implement deflation onto them, eliminating their position, and therefore their salaries will go down by 100%. That's why a lot of people who think deflation is good, that's a pretty good indicator of low financial intelligence and low economic intelligence. Now we go to the US CPI. As always, this is the bls.gov website, and the link for this will be in the description box below, as with all other indicators featured in this video. And we see the CPI over here. The period of steeper than normal growth has been in the past for some time now. It ended in early 2022, 2 years ago, and since that time, this has again been the flat natural cruising speed that we want. And the 10-year compound annual growth rate of this would be this most recent number, 312, divided by the number exactly 10 years prior, which is 236, and then taking the 10th root of that time, because this would be the inflation over 10 years. What is the average compound annual growth rate of this over those 10 years? I'll have a table to depict that after I show you these charts. And we see the inflation blip is getting further and further in the past. On the 1 month percentage change of inflation, 2 month, 3 month, 6 month, and 12 month. Now this is still a plateau that is higher than what we saw over here, but isn't necessarily temporary for reasons that I'll explain. It is because of fiscal deficit spending in the US in an election year and to just expand the welfare state. Some of that fiscal spending is enabled by U.S. purchases of treasuries, but it's not the same as money printing causing inflation, because this is accrued into the ballooning size of the U.S. national debt, and there will be a time in the future when the national debt cannot rise anymore, and therefore all this surplus inflation created by borrowing from the future will in fact have to be reversed, because there will be a time when you cannot borrow any more from the future. Either that or the rate of economic growth will accelerate to such an extent that even this large national debt will seem small. One of those two scenarios, and I talk about that a lot in other videos. But the big spike ended 2 years ago, and now we're in this cruising speed over here. So now we go back to my matrix. So we saw all three, the US CPI 10-year compound annual growth rate, Goldman Sachs Commodity Index 10-year compound annual growth rate, and the 10-year U.S. Treasury yield. So today on April 15, 2024, what is the scorecard? 2.8% for the U.S. CPI. It's getting close to 3%, but it's still not there yet. That's why we use a 10-year window. The Goldman Sachs Commodity Index, the most important of the three, is still in deflation, minus 0.86%. And the 10-year U.S. Treasury yield, this is the only one of the three that is above 3%. It's somewhat of a mystery as to why this has not caused a major real estate crash yet. The ambient momentum of the economy might be delaying that outcome, but this cannot stay high forever if there is to not be a real estate crash. Now let me show you a CPI table for further clarity. So in this March 2024 reading, the last couple of months have been high, 0.4% and 0.8% over 2 months, leading to an annualized gain that is well above 3%, but this is where the data is the noisiest and the most volatile. At the 6-month level, it's 3.2%, at the 1-year level, it's 3.5%, and then as you take 2 years, 3 years, and 5 years, you can see that that big inflation spike in late 2021 and early 2022 is receding further and further in the past, because over the last 2 years, inflation at the US CPI level has still been just 3.9%. That big one-time spike is getting further in the past, and that's why the 10-year compound annual growth rate, even including that big spike, is still only 2.8%. That's not even at the 3% that I would consider optimal. And in the 21st century, the entirety of the 21st century, there has been 78.3% inflation, and that is just 2.5% a year. The 21st century, and I talk about third millennium economics elsewhere on this channel, because the economics of high tech are deflationary in nature, and increasing money supply is needed just to offset that technological deflation. So no, inflation is not high. I don't care what anyone says. These recent months were a little high, but those ebbs and flows occur because until this 10-year compound annual growth rate gets high enough, there's not much point in getting into the weeds about why a certain month was higher. Also, this fiscal factor is independent of whether money printing offsets technological deflation or not, and the fiscal factor cannot continue forever, also for the reason that I mentioned. Now I want to take you to a clip of Bill Maher speaking with William Shatner, and they mention things that I have mentioned on this channel for many years, including how inflation is judged by the price of eggs, for which I have multiple videos. This first one you can see in the upper right hand corner. It's quite funny how hysterical some people get about the price of eggs being twice as high as it was 30 years ago, which is still just about 2% a year of gain. And then this other video, which is part 3 of a 3-video documentary I've made about how conservatives and libertarians have lost their minds of the subject of inflation. So we go to Bill Maher with William Shatner.
Okay, so how will persistent inflation affect Biden's prospects this fall? Does it counteract all the other positive economic news? Well, every time I point out the positive economic news, somebody yells at me in some sort of,
But
somebody writes something like, oh, sure, it's fine for you, Bill Maher, with your private jets.
Yeah, but what is inflation? I mean, how high does inflation have to be before it's inflation?
It's when eggs cost more.
It's what?
It's when eggs cost more. That's
When
what
you
people are
buy
upset
eggs.
about.
I know, but salaries are going up too.
Yes, they are.
It's a peculiar situation. There isn't.
What?
It isn't that bad, and they're just making it sound bad.
Don't say that. They'll yell at you. I'm telling you don't want to say.
So that clip was rather entertaining, but notice how Bill Maher mentioned eggs, and William Shatner, despite being 93 years old and remembering back when certain things cost 1/10 of what they do today, he did mention that salaries are in fact higher than they are today. And William Shatner is not an economist, not even a technology person. He is just an actor, yet had the common sense to mention, well, salaries are higher too, and therefore purchasing power is, of course, higher, even if prices are higher. This should be obvious, but some people have lost their minds on the subject of inflation. Just like many people on the left who are very committed to the environmentalist cause, they will cite a single hot day in the middle of summer as evidence of climate change or global warming. But inflation nuts will cite a single, extremely narrow anecdote as evidence of inflation, and they will not annualize it. They will say that if the price of something doubled over the last 30 years, that's proof of hyperinflation. No, that's proof that inflation is in fact only 2% a year, even in the anecdote that they provided. And I often hear that old people can't annualize things because too much time has passed and therefore they remember the prices of their youth, so they get scared by inflation. But William Shatner is 93 years old, and somehow he doesn't fall into that. Now, if you like this type of content, then I encourage you to subscribe to this channel, and thank you very much for watching.